Look, if you just glance at the charts lately, you might think absolutely nothing is happening with Polygon. No hype, no massive candles, yet. But I'm looking at a report right now from House of Chimera that paints a completely different reality, one that the market is completely ignoring. While the price has been chopping sideways for months, Polygon has processed $37 billion in peer-to-peer stablecoin volume. That is not a typo. 37 billion. And the price? It just woke up. We just hit my first take profit target at 16 cents. And the structure on the weekly chart suggests this might just be the warm-up. But there is a massive resistance level we need to clear first. If we reject here, we could retest 10 cents. And losing it, 6 cents is on the table. But if we break it, the data says we are undervalued by a mile. Let me show you exactly where the opportunity is on this chart. Welcome back to the channel. Look, we need to have an honest conversation about where Polygon stands right now. For the last few months, the sentiment has been brutal. I've seen the comments. Why are you still talking about this? Move on to Solana. And I get it. The price action on the weekly time frame has been painful. We have been stuck in this downtrend since March, bleeding out while other coins made new highs. But this week changed something. We finally saw a strong impulse candle pushing us up from that 10-cent region all the way to 16 cents. Is this just random noise? Or are we seeing a shift in momentum that aligns perfectly with what I'm seeing on the on-chain data? The market sentiment is lagging behind the reality of what is actually being built and used on this network. Most people are trading based on vibes and emotions. We are going to trade based on the chart and the hard data. And right now, the setup is saying that the bottom might finally be in. But as always, we don't guess. We wait for confirmation. Let's get into the fundamentals, because I have a bunch of different data points here that completely destroy the bearish thesis. First, look at this stablecoin data from House of Chimera. Everyone talks about new rails for money, but Polygon is sitting there with over 58 million active USDC addresses and over 43 million USDT active addresses. Compare that to the other chains on the graph. Polygon is leading the pack in cumulative stablecoin usage. Even CryptoRank just put out a report showing Polygon is the number 3 chain by stablecoin addresses, growing from 3.6 million to 5.1 million active addresses in the last year. We are seeing more growth here than Solana, the supposed Ethereum killer, in that specific metric. And it's not just idle wallets. CryptoBusy reported that Polygon just crossed $1 billion in daily USDC peer-to-peer payments. That is real money moving through everyday transactions, not just wash trading or meme coin flipping. This usage is hitting the network limits in a good way. Everstake highlighted that on January 8, 2026, Polygon reached 16.27 million gas per second in throughput. That is the highest level in its entire history. The network is being used more now than it was during the bull run of 2021. So where's this coming from? A huge chunk is Polymarket. DeFi Priest pointed out that Polymarket is reshaping the network's revenue profile. In just the last 72 hours, nearly $855,000 worth of Pol tokens has been burned. That is massive deflationary pressure that the market hasn't priced in yet. Finally, we have the new strategic vision from Sandeep Nailwal and Mark Boyron. They just released the Open Money Stack thesis. They aren't trying to just be another crypto chain. They are going after the $2 quadrillion transferred globally every year. They want to move all money on-chain. When you combine record throughput, billion-dollar daily volume, and a clear roadmap for institutional money, the ghost chain narrative falls apart.
All right, let's get into the weekly chart. If you've been watching my videos, you know I've been tracking this massive structure for months. First, look at these orange dashed lines. This is the descending channel we have been trapped in since the local top back in December of 2024. It has been a perfect guide for price action. Every time we hit the top, we reject. Every time we hit the bottom, we bounce. Recently, we lost the middle of this channel, that descending trendline support that held us back in August. It looked ugly. But look at what happened in the last 2 weeks. We pumped, and we have now recovered that middle channel line, pushing right up to the 16-cent region. This is critical because 16 cents is not just a random number. It was a major support level that we lost, and now it is acting as resistance. It also happens to be exactly where the price is hovering right now. Now, look at the moving averages. The price is currently fighting with the indicators. We are above the 10 EMA. That's the short-term momentum starting to shift. But we are still below the 21 EMA, the blue line, and well below the 55 EMA, that purple line you see there. We need to reclaim these levels to confirm a full trend reversal. But here is the most bullish signal on this entire chart. Look at the indicator panel at the bottom, the Heikin Ashi RSI. I have added these white circles to highlight every time we hit these extreme oversold levels. It happened in October of 2024. Result? 160% pump. It happened in April and June of 2025. Result? 80% pumps each time. We just hit a record low on this indicator since the migration from Matic to Pol in September. And look at the reaction. It has curled up and is leaving the oversold zone. I've marked this with the green vertical line on the price action. Historically, every time this happens, we see a significant relief rally. That relief is happening right now. Also, check the volume profile on the left, that blue and pink graph. The point of control is sitting up at 24 cents. That's where the most volume has been traded. In technical analysis, price often acts like a magnet to the point of control. That gives us a very logical target if we can clear this immediate resistance. So, what's my strategy here? As I told you in the last video on January 2nd, I established a load zone between 10 cents and 13 cents. That's the green box on the chart. If you followed that setup, you are already up nicely. The price has now moved out of that load zone. If you are new and looking to enter, I would not be chasing green candles right here at 16 cents. This is resistance. I would wait for a pullback to re-enter the load zone or wait for a confirmed breakout above this descending channel. For my position, TP1 was hit hours ago at 16 cents. I took some profit off the table. My next targets are 20 cents, which lines up with the 618 Fibonacci level, and then 25 cents. If we get really bullish and the market wakes up to that stablecoin data I showed you, we could look at 42 cents and eventually 60 cents. However, we have to protect ourselves. My stop loss is strictly set at 10 cents. That's the red dashed line. A weekly candle close below this level invalidates the entire bullish thesis for the short term. If we lose 10 cents, the structure breaks, and we could be looking at a flush down to 6 cents. That 6-cent level coincides with the 2618 fib extension to the downside. I don't think that is the likely case right now given the bullish candle and the RSI reset, but as a trader, you must be prepared for the worst. For my long-term bag, I'm not touching it. I have been accumulating since 2021. I bought at 3 cents. I bought at 25 cents, and I added more at 10 cents. But if we drop below 10 cents, I'm not buying any more for the long term until we see a confirmed bottom. Let's map out the game plan for the next few weeks. The bull case. We close the weekly candle above 16 cents and flip the 21 EMA into support. If we do that, the path to 24 cents, that point of control magnet, is wide open. The narrative shifts from dead chain to recovery play, and FOMO kicks in. The bear case. This move to 16 cents is just a dead cat bounce, a retest of lost support before further downside. If we get rejected hard here and close back below 13 cents, the probability of revisiting the lows increases significantly. Personally, I'm leaning bullish because of the Heikin Ashi RSI reset. When an indicator is that oversold and starts to curl up, it usually has legs. Plus, the fundamental usage of the chain for stablecoins provides a floor of value that simply doesn't exist for many other chains out there.
The data proves Polygon is far from dead. 100 million stablecoin addresses don't lie. The chart is showing a classic mean reversion setup from historical oversold levels. We have hit our first target, we have locked in some gains, and now we let the rest ride with a trailing stop. Stick to the plan. Don't let emotions shake you out of a good entry, and don't let greed stop you from taking profits at resistance. If you want to track the setup with me in real time, make sure to join my Telegram group. I posted the update there before I even started recording this video. The link is in the pinned comment below. And remember, none of this is financial advice. I'm just a guy on the internet showing you how I navigate these markets.
Thanks for watching, do your own research, manage your risk, and I will see you in the next one.